Well, Canada and the U.S. will be releasing their latest GDP prints later this week. How will the economies differ? What will indicate terms of the trajectory for the economies? What will economists take away from it? Well, let's look ahead to what we can expect with Benjamin Tal, Deputy Chief Economist at CIBC. Benjamin, thanks so much for joining us this afternoon. So what is your sense of what we should be looking out for when it comes to both the Canadian GDP data, but also the U.S. GDP data?
Yes, Canada, we are expecting about 0.4% for the third quarter. Nothing to write home about. Clearly a slowing economy, something that we have to take into account. The Bank of Canada expected something better than that, and we are seeing the numbers coming weaker than what they expected. 0.4 will be actually a good number. I think it might be even lower. So remember, we're talking about a situation in which the first two quarters were basically zero. The third quarter will be very close to zero. We are operating very close to a recession or something like that. So the U.S. is better. The U.S. is doing much better in any metrics when it comes to economic growth. And that's the difference. You see, I think that it will not be a big surprise if Canada underperform this quarter. The numbers will not be good. This is already priced in. Nobody's expecting Canada to do well, economically speaking, under the heavy weight of higher interest rates. The U.S. is different. If you look at the first three quarters of the year, they've been doing much better than Canada. And I think that's what's not priced in yet. Basically, the consumer in the U.S. is doing better than the consumer in Canada. The consumer in Canada is saving. If you look at the savings rates, it's much higher than 2019. In the U.S., the opposite is the case. That's why the shopping season is doing well. People using their savings to shop. Now, why? Because interest sensitivity. Canada is much more sensitive to higher interest rates, the US less, and that's why they're doing better. Now, if the market start pricing in a weaker US dollar and therefore a weaker US GDP, that will be a totally different story for the long end of the curve. The long end of the curve is now trying to figure out what direction the US is going. I think it's down.
When you're looking at the expectations for U.S. GDP, or while I'm looking at them, Benjamin, on the Bloomberg terminal here, you said 0.4% you're thinking for Canadian for the third quarter. That's the annualized rate. I'm looking at the estimate for third quarter GDP for the U.S. Is 5% right for their third quarter?
Yes, 5%, absolutely. They are growing much faster than Canada. We are basically zero. They are at 4 or 5%. Now, the question is why? We have to remember a few things here. First of all, the sensitivity to higher interest rates. Our mortgages are for 5 years. Their mortgages are for 30 years. So when you are facing renewal in Canada 6 months from now, 12 months from now, what do? You start saving money in order to meet that renewal situation. In the US, wake me up when it's relevant. Yeah, it's 30 years, so they are not doing it. That's why their savings are down. That's the consumer. Then you have fiscal policy. If you think that Trudeau is spending a lot, try Biden. Biden is spending like there's no tomorrow. We all know that. So fiscal policy is definitely there, helping the US economy versus Canada. And then you have a situation in which the overall story of the American economy is very different than the Canadian economy. And therefore, there is this sensitivity to higher interest rates that is really impacting Canada much more than the US. So all those factors suggest that the US is doing better. Add to it productivity. They are rising by 3%. We are rising by 0, basically, or negative.
Right.
So that's another factor. Now, I suggest that the fiscal policy will not be there. The consumer will stop spending and start saving in the US. So all those factors belong to the past. Now, if you look at the chart that we provided, you can see that the ratio of leading indicator to coincide indicators, like current indicators, is going down, which means what we are seeing now is the here and now. What's coming is much weaker. And that's why I think the market is not pricing in enough slowdown momentum in the US. And I think that's the next shoe to fall.
It's really... Excuse me, Benjamin. It's really interesting to think about the U.S. economy firing in this way or continuing to fire in this way. And yet our central banks in both countries have the same goal of trying to slow things down in order to get to that inflation target. Can both countries hit that target, but take a different path to get there? That the U.S. economy is continuing to grow at this sort of pace, but if productivity is increasing at the same time, can it still get to that 2% target along the same timeline as we will be, or will it be a little bit later? Do you think?
Yes, it will be later. I think that usually Canada follows the U.S. Now the opposite is the case. The U.S. will be following Canada. The U.S. will be slowing down over the next 6 months. All the indicators suggest that the U.S. is going to slow down. If you look at business credit going down, if you look at leading indicators going down, if you look at the housing market, it's going down, investment going down. So clearly leading indicators suggest that the U.S. will slow down, and that's a good thing. However, the time frame is different. Therefore, we expect in 2024, the Bank of Canada to cut 150 basis points, while the Fed will be cutting only by 50 basis points, reflecting this difference.
So this comes back to then sort of rate expectations and yields that you were talking about. So if the U.S. is a bit behind where we are, but so much relies on the U.S. and the what's happening there, what sort of influence or effect would that end up having on Canada?
Big time, because first of all, the currency is impacted by that. That's one of the reasons why the US dollar is going down against all other currencies, but not against the Canadian dollar, because the market is pricing in a situation in which the Bank of Canada will be cutting more than the Fed in 2024. So that's significant. And we have a situation in which the Bank of Canada will be leading the Fed in the cutting trajectory. And that's something that we haven't seen in a while. Clearly an impact on the Canadian dollar. Another factor is the 10-year rate in Canada. The 10-year rate in Canada is influenced heavily by what's happening in the US. So even if Canada is slowing down, the decline in the 10-year rate is not enough to justify what's happening, because we're still waiting for the US to slow down. The minute it happens, you'll see another leg down for the long end of the curve.